Hello everyone, welcome to the Alpha Hustle and the Market Profile Paathshala series that talks about the market profile starting from the basics to the advanced concepts. Let's jump right into today's chapter.
So in chapter 3, we're going to talk about two important concepts of market profile, a balance and excess. I would say these are the heart and soul of the market profile. So what is a balance? We kind of touched upon the basics of the Wyckoff market cycle or the diffusion model in chapter 1. If you haven't watched the video, I'll leave the link in the description below as well as in the iCard above. So the market never moves in a straight line. So market auctions from a balance to an imbalance and back to a balance again. So this can be attributed to the Wyckoff market cycle, the picture that we have on the left hand side. So balance is nothing but a zone where the market starts to trade sideways, which essentially means a fair agreement between the buyers and the sellers where they match each other. So this is a zone where the early adopters or the innovators get into the market and either accumulate their positions or distribute their positions before kicking off an imbalance move. So the balance can be attributed to either a consolidation or accumulation or distribution or congestion zones, whichever school of thought that you belong to. But essentially what we are saying here is that the market starts to trade sideways before taking a directional move, which is called an imbalance move. So this market auction cycle from a balance to an imbalance and back to a balance again does happen and repeat itself on all the different time frames. So whichever time frame that you trade on, you would tend to see a balancing action and an imbalance moves. The larger the balance is going to be, the bigger the imbalance move will be. For example, let's say if the market has been balancing for the last 2 or 3 months, an imbalance move out of this 3-month balance is going to be always bigger than an imbalance move out of a 3-day balance. So the larger the balance it gets, the bigger the imbalance move is going to be. So which is why it is very important to identify the balance zones and then figure out when the market starts to imbalance out of that balance. So in a standard traditional technical analysis terms, you would call this as a consolidation zone and a breakout or a breakdown out of this consolidation zone. So this consolidation can either be an accumulation, distribution that could happen on whichever time frame that you trade on. The market price action still remains the same irrespective of whichever school of thought that you follow. So having said that, what is an excess? So as we discussed in chapter 1, market is a two-way auction process. So the market goes higher till the last bidder bids and the market goes lower till the last seller offers. So which is where an excess would come into the picture. Excess marks the completion of the current auction and confirms the start of a new auction. So let's take a quick example. Let's say market had a small balance and started an imbalance move to the upside. So once the imbalance move is complete, the market starts to balance yet again with responsive sellers stepping it at some key references. So this is a balance or a sideways consolidation zone, as you may call. So for this example, as a hypothesis, let's assume that this is a distribution of the longs. So what essentially happens is the innovators or the early adopters never want the retail crowd to travel with them. So there could be the retail responsive sellers jumping in on every rise within this balance. So eventually what smart money does is get a spike above this balance where the stops for the most of these responsive sellers would be, and then comes back into the balance and starts an imbalance move to the downside. So this spike that we have out of a balance marks the completion of the auction to the upside and confirms the start of an auction to the downside. So this essentially is called as an excess. So similar to balance, excess is applicable irrespective of the time frame. You could have excesses on a monthly chart, on a weekly chart, daily, 30 minutes, 15 minutes, whichever time frame you may call it. You would be able to see a balance and an imbalance move. However, from a market profile perspective, we always trade with a 30-minute time frame. So you would see an excess and a balance even on a daily chart with a 30-minute time frame, which we're going to see in a bit when we talk about the different profile shapes. So let's take a quick example to understand the balance and the excess a little better. So this is a weekly chart of Nifty. As you can see, we had a nice markup phase and then the market started to balance within a broader range for about 15 to 16 weeks. And what we essentially had a spike above the balance where the buyers failed to get a follow through. So this is the excess that we were talking about in the earlier example. So market left an excess confirming that the auction to the upside is pretty much complete and we may likely to have an auction to the downside. So on the subsequent weeks, again, sellers tried to probe towards the balance high where they eventually failed and the sellers took the control of the auction, start the one time framing to the downside. So this eventually led the auction towards the low end of the balance. So the excess confirmed that the auction to the upside is complete and we started the auction to the downside. And similarly, we had an excess below where the sellers tried to look below the balance, failed to get a follow through and started the one time framing to the upside during the subsequent week. So this confirms that the auction to the downside is complete, forming an excess and start of an auction to the upside towards the balance high. So the market rallied for the subsequent weeks, one time framing to the upside, eventually got a breakout above the balance high. So we call this as a balancing action, which we had for 15 weeks. And what we are essentially having now is an imbalance move out of the balance. So this cycle of balancing or imbalancing moves does happen on every time frame as we discussed. So this is just for an example that we have looked at the weekly charts, but the phenomenon of balancing and excess and start of an auction to the opposite direction could happen on any time frame. Having talked about the balance and the excess, let's look into the different profile shapes that could be formed on a daily basis. So the first type of the profile that we're going to talk about is a long liquidation profile. So which is denoted by a B shape. So as you can see, the market kind of formed a B shape, so which denotes that the liquidation of the week longs from the previous day and doesn't actually mean that there is some serious money or smart money selling into the market. So in case if there is a serious money or new money coming into the market, the expectation is that we would not form a balance, but rather start to one time frame to the downside, forming an elongated profile. We're going to talk about that in a bit. So what essentially happened during this day is market started off within the prior day's range or value area, started liquidating to the downside. So once the initial balance has been formed, some responsive buyers stepped in to halt the selling pressure. So this confirms that we are essentially forming a B shape and no serious money selling into the market. So this gives some nice trading opportunities, especially during the second half, to do some scalps, especially within these B loop rotations. So you buy at the low end of this balance and sell at the high end of the balance, or rather sell at the high end of the balance for a rotation back towards the low end of the balance. So what we are essentially having is an excess followed by a balance. So this could eventually turn out to be a continuation to the downside, which is to be seen whether the sellers would get a follow through on the subsequent day. If not, this would again result back in a short covering move, taking out all the sellers within this excess. So often the B shapes are generally formed as a resultant of a liquidation break due to exhaustion at some key important references. So this denotes that essentially the old business is liquidating as opposed to new money coming into the market. The next profile shape that we're going to talk about is a short covering profile, so which is denoted by a P shape. So as the picture denotes, the market starts off with an excess at the lows and starts to balance out at the top, forming a P shape. So this denotes that the weak shorts from the market are covering from the previous day and doesn't guarantee some strong or serious money coming into the market. Again, as we discussed earlier, if it is some serious money coming in that's buying into the market, we would not see a balancing action above the initial balance. It would rather start one time framing and have an elongated profile. So similar to the B-shaped profiles, the P-shaped profiles do provide some nice trading opportunities during the second half, especially within this P-loop rotations. So you buy at the low end of this balance, sell at the high end of the balance, or sell at the high end of the balance towards the low end of the balance. And this long buying tail called an excess. So we often see these P-shaped profiles forming where market being too short, some strong responsive buyers emerging within the market and trigger the short covering move to the upside. So the next set of profile shapes that we're going to talk about is a Q and D shape profiles. So Q shape, which is the picture one below, denotes the exhaustion by the buyers. So the buyers start with a strong note leaving an excess after the open, however, doesn't get a follow through and starts to balance in a short range. So this shows that there are some responsive sellers coming into the market who are restricting the buyers from heading higher. So this is a sign of weak buyers who are not able to match the sellers coming into the market. This often results in inventory adjustment of weak longs, which means that throwing out the weak buyers from the market by having a liquidation break and see if some strong buyers emerge to start a rally to the upside and take out these sellers eventually. So similar to a Q-shaped profile, the opposite side of a Q-shaped profile is a D-shaped profile. The sellers start strong in the market, create an excess or a selling tail and starts to scale down. However, doesn't get a follow through and starts to balance or trade sideways. So this suggests that there are some responsive buyers that are stepping in at some key references and are halting the selling pressure. So in case if the sellers doesn't get a follow through for a long time, which means that the ones who drove the market to this reference are some weak hand sellers. And what eventually market does is throw out these weak hand sellers out of the market and see if some strong sellers emerge this time around, come back to this level, revisit and see if these responsive buyers can be taken out. So these are some of the weaker structures that often get revisited in the future because the exhaustion is driven by the weak hand buyers and the sellers. So in the majority of the cases, these zones will be revisited for the test of the strength by the responsive buyers or the sellers respectively before deciding the next course of action. So the next profile shape that we're going to talk about is a balancing profile. So which is denoted by a D shape. So this is nothing but a nice bell curve formed on the charts, which denotes that we have some low confidence market and we are essentially waiting for some more market generated information. So this sort of range or a balance will be formed on the event days where we are waiting for an outcome or a binary event to happen. And these are the days that offer some scalping opportunities and not to be a trend follower, where it favors the buyers and the sellers to attempt some mean reversion trades above the initial balance high or below the initial balance low. So this generally occurs when the buyers and sellers come into a balance and essentially are used by the smart money to build their positions. It could be either short positions or long positions, known eventually once we start an imbalance move out of this balance. So it could either happen on the upside or on the downside. So as we discussed earlier, market doesn't move in a straight line. So market often balances. Once the balancing action is complete, the market starts to imbalance once the early adopters and the innovators either accumulate or distribute their positions. So the last profile shape that we're going to talk about are the elongated profiles. So what does these elongated profiles mean? So this is nothing but we are essentially getting new money into the market or the new business into the market. So this picture that we're talking about where some strong sellers emerged into the market. So we had a nice balance during the prior day where the buyers and the sellers agreed that this is a fair value to trade. On the subsequent day, the market opened right within that range as well as the value area, and the sellers drove the market down. So what we had were some nice short positions being built up by smart money. And once we started having this imbalance move with a strong selling tail, all the buyers that accumulated their positions within this balance would start to cover. New money coming into the market as well as the old business, which are the weak buyers within this balance, starts to cover. So we would get an elongated profile, which essentially starts to one time frame on every 30-minute prints and starts to scale lower. So similar price action could happen to the upside as well, where the strong buyers emerge within the market, the new business comes into the market along with the old shorts covering, which would create an elongated profile to the upside. So these denote some strong trend days in the market, either to the upside or to the downside. So these are the days where you should not be attempting for mean reversion trades. Always stay with the trend whenever you get such kind of days where the market just rallies in one direction. So let's take a quick pause here. So we talked about two most important concepts of market profile, the balance and the excess. I hope this information has been helpful. We'll talk about references and what acceptance and rejection means in our next chapter. In case if you find this content useful, please do like, share, and subscribe. Thank you very much.